What's up guys, Ben here and welcome to Motivation to Invest. We live in crazy times, from the recent global health crisis to the stock market rebounding to all-time highs. Now in these crazy times, it's very easy to get into a false sense of security and say this time it's different. This time the stock market won't recover, or this time this over-optimistic attitude which is occurring in the stock market won't result in a bubble and it won't pop. It's very easy to get into that false sense of security. So to ground everybody and allow everybody to see some rationality in this madness, I've created this video on the historic stock market patterns. This is an essential video and I believe every single investor should know these facts. This will help you make better decisions, make better investments and become financially free. I got some great inspiration for this video after reading Unshakeable, the book is here, by Tony Robbins. This was an incredible book and extremely insightful. If you're interested in reading the entire book, I'll leave a link for Amazon below where you can purchase it. But with that being said, let's get into the video. Right guys, so diving in, Unshakable, an unwavering and undisputed confidence, a steadfast commitment to truth, presence, peace of mind, and calm amidst a storm. Now, if you exercise these qualities during market crashes or even market booms, you are sure to do better than the average investor. Next slide, decisions equal destiny. Winter is coming, we hear that so much. When is the next market crash? Is the stock market overvalued? Is there going to be another crash? Is there a bubble that's about to pop? We hear this so much. And the fact is, nobody can predict the future. Not all these economists, not all these people on CNBC, nobody can predict the future consistently. Yes, some people get lucky, they make a few correct predictions, and they're classed as psychic. However, consistently doing this has not been proven. So what's the solution? Well, if you guys watch this channel regularly, you'll know I'm a practical investor. And I don't believe in just giving people these principles and theories and not applying it practically as I invest my own money. So the same strategies I use, I give to you guys. So we know winter is coming. And what's the best thing to do when winter is coming? Well, firstly, it's not to stand outside in the cold with no clothes, unprepared. That is just complete madness. The best thing to do is get yourself a nice log cabin, get yourself a nice fire, get some marshmallows and roast them and relax. Relax and wait for spring and wait for summer to come. Now, in the stock market, we don't know when winter is coming. We don't know when the crash will be. We don't know when a bubble will pop. We never know when, but we do know it will come at some point, as the market is like a pendulum that swings back and forth, from overly fearful to overly greedy. Preparation is key. And what you want to prepare for is every eventuality. So I'll go through that in my core 4 principles in the next few slides. But firstly, let's look at some historic stock market patterns. First stock market pattern here. Fact 1, stock market corrections occur once a year since the 1900s. So once a year, at least, there is one stock market correction. So history doesn't always repeat, but it does rhyme. That is a great quote by Mark Twain, and also Howard Marks, the great investor, founder of Oaktree Capital, uses that quote a lot. And that resonates with me so much. So the average correction lasts only 54 days, less than 2 months, and the average drop is 14.5%. The key here is not to get scared out of your stocks when that happens, because it's happened historically since the 1900s once a year. So it's part of the system, it's part of the game. If anything, as you know it's a regular pattern, you can take advantage of these opportunities and buy on the dip. Now I did a previous video on the tech market correction and I helped many people to identify a buy point on some great stocks, such as Amazon, Tesla, and Alphabet. So the second stock market fact, less than 20% of corrections turn into a bear market. So firstly, what is a bear market? Because these terms are thrown around, but what is it exactly? So A bear market is a prolonged market period in which an investment has prices that fall, typically categorized a stock market that's fallen by at least 20% from its previous high. So that's what's classed as a bear market, usually a 20% decline from its previous high. The average bear market lasts approximately 11.7 months, so 1 year is the average bear market, but they do vary widely. So these markets occur every 3 to 5 years according to the historical data. However, the good news for most investors, and this helps a lot of people not to get fearful of the market, is that less than 20% of corrections turn into a bear market. So 1 in 5 of these corrections will be a bear market. So just be aware of that. When you're investing in, say you're buying the dip, your odds of succeeding when buying the dip are in your favor. However, that doesn't mean it's definite. It doesn't mean that this won't be the big crash, like what happened back in March. But these are just some facts to help you make better decisions. So what about bull market? Well, a bull market is classed as a prolonged market period in which an investment has prices that rise faster than the historical average, typically characterized by a stock market rise of at least 20% from its previous low. So the average bull market lasts 55 months and has a gain of over 153%, with the average loss in a bear market of minus 30%. So if you look at the risk-reward ratio of the stock market in general, you can see being invested into the market is definitely in your favor. The average bull market lasts 55 months. You can increase your winnings by 153%, whereas the average loss is only 30%, and that lasts for 1 year. Fact 3. So bear markets happen every 3 to 5 years. When the stock market does decline by minus 20%, just know that this is part of the game. Don't get into a false sense of security and think this time it's different, this time the world is over. A lot of people did this back in March when the health crisis happened. The stocks were crashing. I encouraged everybody to invest as much as possible during that time because stocks were on sale. Those of you guys which listened to me made healthy returns. I myself, I invested into numerous stocks. I went so hard. Many of my stocks, at least 4 or 5 of my positions, are up by over 100%. Including sort of Tesla, Etsy, Boohoo stock, which is a UK fast fashion stock. They were all up by over 100%. Etsy's actually up by over nearly 172%, and Tesla's up by 300%, which is crazy. However, I do understand that when the market crashes and stocks decline, it can be worrying. That's why the great investor Peter Lynch says, you don't need brains to invest into the stock market, but you need a good stomach. Here's a good fact for you. In more than a third of bear markets, the index has plummeted by minus 40%. So in a third of cases, you may have to watch your stocks decline by minus 40%. Just knowing these cold, hard facts right now will help you to prepare psychologically for when this does happen. Can you be strong enough to sit there when you watch your stock decline by minus 40%? Can you be strong enough? Can you hold on? If not, then don't invest in the market. Just leave the game to somebody else. Try index funds and you'll be less worried. Fact 4. So this is an interesting one, and this is one that I live by. The best opportunities come in the time of maximum pessimism. So as the great Warren Buffett says, be fearful when others are greedy and greedy when others are fearful. I exercised this during the market crash, March, April. I went in hard. I actually have a 6-figure portfolio now. I went in so hard. And it just shows you that when everybody else has been fearful, that is the time to be greedy. But conversely, now we see a time when a lot of people are actually being quite greedy, especially with a lot of these stocks such as Tesla. And I'm not saying that Tesla won't continue going to the moon. When everybody else is being greedy and chasing these big profits, that is the time when you need to step back and say, okay, does this make sense? Does the fundamentals of this process make sense? I saw the same thing happen in cryptocurrency. I invested in a lot back then and it plummeted and crashed. Luckily, I made a little bit of profit before, so I was okay. But a lot of people lost a tremendous amount of money in the Bitcoin crash. Now I know crypto is increasing back in popularity and maybe it will continue increasing in price, but just be aware bubbles can occur. Fact 5, this is another one of my favorites. The market moves in cycles. As the great Howard Marks says, founder of Oaktree Capital, nothing goes in one direction forever. Cycles always prevail eventually. Just about everything is cyclical. So another quote by Howard Marks, several things go together for those who view the world as an uncertain place. Healthy respect for risk, awareness that we don't know what the future holds, and understanding that the best we can do is view the future as a probability distribution and invest accordingly. Insistence on defensive investing and emphasis on avoiding pitfalls, to me, that is what thoughtful investing is all about. Howard Marks' mantra is proceed with caution, but the key here is he still proceeds. Like he goes into battle, but he does it in a smart way. And that is what I firmly believe should be the case. Don't sit on the sidelines and not invest into the stock market. Invest into the stock market, but do it in a smart and intelligent way. So historically, the US market has hit an all-time high 5% of all trading days. On average, once per month, the stock market will hit a new all-time high. So when you see a CNBC article and it says the stock market is at all-time highs, it's going to crash, bear in mind that this happens once a month. Yes, one of those predictions will be correct, and that will be a market correction or a market crash, as happened with the tech stocks just a few weeks back. So the market was at an all-time high. There was a lot of exuberance in the market, stimulus packages. I did have a strong feeling that a correction was coming. It wasn't a major correction, but a correction did happen. That was a great time to get in there and get some good deal. More on the market moves in cycles. So bear markets become bull markets and pessimism becomes optimism. And also optimism becomes pessimism. So if I take you through the emotional roller coaster of 2020, in March, we had a lot of pessimism. That was the time to be optimistic. And now we've come out of March, we're now April, May, June, July, August, September. We're moving into 2020. There's still a little bit of caution. However, the market shows a vast amount of optimism. So now the question is, historically it says this is the time to be a little bit more pessimistic. Doesn't mean you're going to sell your stocks or sell out of anything, but you're just going to be a little bit more aware. Historically, every single bear market in the US has been followed by a bull market. So here you can see the market cycle. So you have optimism, excitement, euphoria, and that is the point of maximum risk in investing. Then you have denial, fear, panic, despondency, depression, and that is the point of maximum opportunity. Hope, and then optimism. So it's like a pendulum, swings back and forth. Now there is a caveat to this. Now although the stock market has risen periodically over the past 100 years, there is a few interesting cases. So the Japanese market has actually done terribly since the 1980s. However, an interesting point which I come across recently is that Berkshire Hathaway, Warren Buffett's investment firm, has recently disclosed some investments in Japan. So they've actually invested $6 billion in 5 Japanese companies, including Mitsubishi. Now, the Japanese market has always been one of those to steer clear of. As you can see from this graph here of the Nikkei in 1984, it hit a major bubble where there was a lot of exuberance around Japanese products, and everyone said Japan was going to take over the world. They had the motorbikes, they had Yamaha, Kawasaki, they had all the electronics, they had everything. This was a lot of exuberance, and as you can see from this graph here, there was euphoria. And this was the point of maximum risk for Japan. And then that bubble popped and it declined massively. And then it's just started to recover slightly, but still, it's at the same level it was, say, 20, 30 years ago. And that is terrible to see for all those Japanese investors. But Warren Buffett's now making bets on Japan. So maybe things are changing in the future. Maybe we should start looking at Japan. Let me know in the comments below if you're invested in Japan or you're interested in any of their stocks. I've always thought from an intuition point of view, they have a great economy. Fact 6, being out of the market is often the greatest danger. Now, another Warren Buffett quote here, time in the market is greater than trying to time the market. JP Morgan study, 6 out of the 10 best trading days occurred within 2 weeks of the 10 worst days. So just after a market crash is the best time for stocks to boom. Ray Dalio, he says cash is trash. For example, if inflation is at 2%, which is where a lot of the central banks aim it to be, then you pay at least 2% tax on your cash every year, and it erodes in value. Now, this is usually felt at anything above, say, $80,000, but still 2%, you're losing 2% from it just sitting in your bank. So sitting on the sidelines can be costly, and missing 10 of the top trading days can reduce your returns by half. So let's say the average return of the S&P 500 is, say, 8%. If you miss just 10 days out of the market, your return would average at 4%. Now, this is from a JP Morgan study. Now, onto the core 4 investing principles. First principle, don't lose. Now, we often forget this and we take crazy risks, especially in the current climate with so many companies going to IPO, so many unprofitable, exuberant growth stocks. However, it's important to ground ourselves and say, core principle, don't lose. Warren Buffett, rule 1, never lose money. Rule 2, never forget rule 1. The more money you lose, the harder it is to get back where you started. Now, this is a mathematical fact, which I've spoke about in my previous videos. If you lose 50% of an investment, you require double the return, so that's 100% to break even. Now, the reason for that is, say you have a stock that's worth $100 and it drops to, say, $50. If you have a 50% increase on that, it's only going to reach $75. It won't reach to $100 yet, so you need double the return. It's just a mathematical fact. This is why a lot of traders, they use a stop loss, they use an 8% stop loss, because they know after 8% it's much more difficult to regain that profit. Defense is 10 times more important than offense, Paul Tudor Jones. Charlie Munger also says this as well. He says, approach investing and even approach life in an inversion process, rather than thinking, what can I do to be successful in a certain sport or in investing? He says, what should I not do wrong? Ray Dalio says, design an asset allocation that ensures even if I'm wrong, I'll still be okay. Warren Buffett says, I don't jump over 7-foot bars. I look around for 1-foot bars I can step over easily. Core principle 2, and this is another one of my favorites, and it adds a completely new paradigm to investing. So most people think of investing as you've got to go high risk, high reward. And yes, in many cases that can be true. However, you shouldn't aim for that. Aim for low risk, high reward. You could compare this to flying. Like, we all fly everywhere. And you may say initially, actually flying's quite risky. You're up in the sky, 30,000 feet above the atmosphere in a metal box with a couple of engines attached. That seems quite risky. But what do? Well, they minimize this risk by putting the planes through a variety of technical procedures before takeoff. The engineering is superb and the pilots are well trained. They minimize the risk so people can have the high reward of going on holiday and vacation to different countries. Paul Tudor Jones, the trader, he used a 5-to-1 rule. So I'm risking $1 with the expectation to make 5. Now 5-to-1 allows him to have a hit rate of just 20%. So in other words, he can lose 80% of the time and still be in profit. Richard Branson, the British entrepreneur, billionaire, who is often stated as a major risk taker. We've seen him on jetpacks. We've seen him here doing some jet skiing with a naked woman on his back. When Richard Branson started Virgin Airlines, he started with just 5 planes, and he actually spent over a year negotiating to potentially return those planes to Boeing should the venture Virgin Airlines not work, as it was a very difficult challenge, as he was against the behemoth British Airways. So the key here really is to understand what risk reward is. What's your risk premium? For example, if I paid you $1 to cross a country road, you'd probably do it. You'd be like, okay, here's $1 or £1 or €1 to cross the road. Just one simple road. No cars, just to cross. However, if I said to you, okay, I want you to cross that 4-lane highway for $1, you might be like, you know what, I don't think I want to do that. That seems much too risky. Because of the greater risk, investors ask for a greater reward. That is called the risk premium. So know the risk premium. So an investor might say, okay, well, I'll go across the 4-lane highway, but I want $1,000 or I want $2,000 or I want $3,000 to go across that highway and risk my life. But I'm not doing it for $1. And this is how treasury bonds are set up and corporate bonds and even those in emerging markets. If you invest into a treasury bond from, say, a government, that's a very safe investment. Say it's a Western government such as the USA. So they offer a very low rate. So if you invest in, say, a government bond for an emerging market country with a more volatile government, such as, say, Venezuela, they will offer you a much greater rate because you have the extra risk. Core principle number 3, be tax efficient. Now, I won't go into much detail on this. Keep to the law, but know the law and be tax efficient. So in the UK, you can invest up to £20,000 per year in a tax-free ISA. That means you pay no tax on your investments. Also, you don't pay any tax if you don't sell, because usually if you sell, you have to pay tax on your capital gains. US citizens, take advantage of your 401k, and also I'm sure you have ISA alternatives there. Core principle 4, diversification across different asset classes. So diversification is the only free lunch in investing. That is what Harry Markowitz said, a Nobel Prize winner. Ray Dalio, the world's largest hedge fund manager, says you should look for the holy grail of investing. That's 15 uncorrelated revenue streams. If you have those, you can ensure your portfolio is safe but also producing high returns. He also created an all-weather portfolio. So as you can see here, he has treasuries, gold, cash, and then he has stocks here and different commodities and real estate and property, all to create this portfolio that no matter what happens when winter comes or when it doesn't come, you'll still do well in the stock market. Now, I did a video on Ray Dalio's portfolio, so you can check that out on the links below. So that's it, guys. I hope you found that informative. I tried to give you just some cold, hard stock market facts to help you make some rational decisions. So the key takeaways here really are to stay invested into the stock market, but do it in a smart way. And I have some great videos on this channel to help you guys out, so you can check those out. I'll leave many links below. You can check out my great stock picks. A friend of mine even did a portfolio reveal of over £100,000. That is a fantastic video if you're new to investing and you want to see how a real investor grew that portfolio from investing just £2,000. Incredible story. And yeah, if you've not got an investment account, I also have links for Trading 212 and the Stake app. So you can check those out in the link below and you'll get a free share worth up to £100 or $100 when you sign up. So what are your thoughts? What are your thoughts on the patterns in the stock market, and what do you think are my core 4 principles? Comment below your favorites. And if you guys enjoyed this video and found some real value, go ahead and give it a big thumbs up. That really helps out with the YouTube algorithm, which allows me to create more great content like this for you guys. In addition, if you want more investing tips and exclusive stock market picks, which I personally am investing into, then you should definitely subscribe to this channel and turn that notification bell on. With that being said, I will see you guys in the next video. Invest safe.